Hello students, finance is the lifeline of business. It is required to run the business, to modernize it, to expand it, etc. It's not how much money you make, it's how much money you keep, how many generations you keep it for. So while you hold on to that thought, let me explain financial management. Today we are going to do financial management part 1. So what are we going to learn in this? First, we understand the concept of financial management and then the role of financial management in the organization, and we'll also discuss the objectives of financial management. So before we start with financial management, let us understand what financial management is and how important the role of a finance manager is. Let's take an example. Suppose you want to construct a house for 50 lakhs and this construction will take 3 years to complete. So anything can happen in these 3 years. Now there are 3 possibilities. Either the house will be constructed in 45 lakhs or the house may be completed in 50 lakhs as you had estimated, or the cost may go up to 60 lakhs. So let us evaluate each of these alternatives. In the first case, you completed the house in 45 lakhs. Now you had arranged finance for 50 lakhs. So you have surplus 5 lakhs, but nobody returns this surplus. They will use that in decorating the house, making modular kitchen or texturing, etc. So that money will be used. Now, if you make your house within 50 lakhs, then that is just 1/3 possibility. Your house getting completed in 3 years, in the estimate that you made, is only 1/3. Now, what happens if the cost goes up to 60 lakhs? Now, when you're making a house, you're not going to leave it half done. So it's not that you will not make the windows and the doors. You have to complete the entire house. So therefore, you'll have to raise finance at a short notice. So when you have to raise more money at a short notice, you will get it at a high rate of interest. Now, this was regarding making a house. Now, what about the finance manager? So if we put the finance manager in this situation, suppose a finance manager had to start a project with 50 lakhs and starting that project would take 3 years. So he estimated that the cost of starting the project would be 50 lakhs. What if he gets it made in 45 lakhs? He overestimated the entire cost. So he had idle funds. Now, because you have idle funds, you are free with your expenditure and he might incur that expenditure also in the business. So as a result, he's paying extra interest on that 5 lakh, which he had raised 3 years back. So if you are paying extra interest, what happens to your profit? Your profit goes down because extra interest means more cost. So in the first situation, the finance manager's decision has cost the company extra interest and therefore the profit has gone down. The second possibility, that the finance manager completes the project in 50 lakhs, is only 1/3. And the third possibility, suppose the cost goes up due to various reasons. 3 years is a pretty long time. Anything can happen. So suppose the cost goes up to 60 lakhs and now the finance manager is short of 10 lakhs. So he has to raise that because he has to complete the project. So he has to raise that money. And definitely when you have to raise money at a short notice, you will have to pay more interest. So again, if he's paying more interest, the cost will go up. And if the cost will go up, the profit will go down. Therefore, the finance manager of a company has to be very prudent and he should have a lot of experience and vision to be able to run his company on good grounds. So having explained what financial management is, let us see the meaning. So I've highlighted the main points here, that the finance manager has to ensure availability of enough funds as well as avoid idle finance. So if I go back to the previous slide, you will see that in the first case of 45 lakhs, there were idle funds. So he's supposed to avoid that situation. As well as in the third case, there was shortage of funds. So the finance manager should have availability of funds also ready. Now that brings us to the role of the finance manager or role of financial management. There are 5 important roles that financial management has. Let us start with the first. The first role is the size and composition of fixed assets of the business. Like the example that I had given earlier, that the project is for 50 lakhs. So this also the finance manager decides that what is going to be the size of the project that is undertaking. So look at the example given here, whether the project is going to be for 100 crores or it's going to be 50 crores. So because he has to arrange finance for that, so first of all, he decides what are the fixed assets and what is going to be the size. So whether he's going to start with fixed assets of 100 crores or 50 crores. So accordingly, he'll have to arrange the finance also for that. Then once he decides the amount of fixed asset, then the second role that financial management has to do is the quantum of current asset and its breakup into cash, inventory, and receivables. So once he has decided what the fixed assets are going to be, then he has to decide the amount of current asset that relate to that fixed asset. For example, if he has decided that he's going to start the business with 10 machines, then the raw material that should be available should also be for 10 machines. Suppose he decides that the business should start with 20 machines. Then obviously the raw material or the current asset that would be required for the machines would be for 20 machines. Suppose the fixed asset is 20 machines, but the current asset, that is raw material, is only for 10 machines. Now what happens in this situation? That some of the machines are lying idle and some of the workers are also waiting to get some work to do. So he has to balance the amount of current asset with the amount of fixed asset that he has already decided. And not only does he decide about the current asset, he also decides about its breakup. Then come to the amount of long-term and short-term funds to be used. Long-term and short-term funds are used for different purposes because their cost and the risk is different. The liquidity, profitability, everything is affected by long-term and short-term funds. So let us see, why does he need to distinguish between long-term and short-term funds? First of all, on the basis of cost. Now let us take another example. Suppose the finance manager has raised a finance of 10 lakhs. So and for 10 years, that is long-term. So if he is going to pay interest for 10 years, that is definitely going to be more than if he takes 10 lakh for 1 year. If he takes a loan for 1 year, then the interest that he's going to pay will be for 1 year. So therefore, the long-term loans are more costly than short-term loans. So this point goes in favor of long-term loans. Now, the second point is liquidity. Suppose a finance manager has taken this loan of 10 lakhs and to be repaid over a period of 10 years, that means he has to repay 1 lakh every year plus interest. So the burden on the company is only 1 lakh per year. But suppose he has taken a short-term or a medium-term loan on, say, let us say 2 years. So 10 lakhs has to be returned in 2 years. That means 5 lakh plus interest. So naturally, the amount of money with the firm would be less. Liquidity means amount of cash available. So long-term loans provide more liquidity and short-term loans provide less liquidity. So the cash available with the finance manager to buy current asset or meet other expenses are much less in case of short-term loans as compared to long-term loans. Now, what about profitability? Now, profitability is directly related to cost. Since long-term loans, more interest is paid, therefore the profitability will be less. And in short-term loans, less interest is paid, therefore the profitability will be more. These are the differences between long-term and short-term funds, which the finance manager has to decide before he takes a decision as to what source of fund should he raise. Then the breakup of long-term finances into debt and equity. Now, these long-term finances are for a long period, and therefore he needs to know that what should be the source of this long-term finance. Again, he will weigh the pros and cons of both long-term sources, that is debt and equity. So let's see that. Equity is more expensive than debt because debt carries a fixed rate of interest. In equity, there's no fixed rate of interest, and therefore the amount to be paid to the equity may be much more than that is to be paid to the debt. But the second point, risk, equity is much less riskier than debt because debt you have to pay, whether you have profit or no profit, you have to pay the interest on debt. So there's an element of risk. But in case of equity, the risk is not there, not as much as in debt, because if there's no profit, you're not bound to pay dividend. If you have profit, then you pay dividend. If you don't have profit, then you're not bound to pay dividend. And then the mode of payment, in case of equity, it's dividend. And in case of debt, it is interest. So again, the finance manager has to see the breakup. And finally, He has to decide all the items in the P&L account, that is interest, depreciation, etc. So actually, most of the items, if not all, that are appearing in the P&L account are all decided by the finance manager. Let's see, interest paid. So depending upon the amount of debt that he has raised, interest is decided. Then dividend depends upon the equity. Then depreciation. Remember, we did the size of the fixed assets. So if the machines are more, depreciation will be more. Again, the repair would be of this machinery and other things that are used. And salary to be paid to the people who are working on them. So these are the 5 important roles of financial management. Now let us do the objective of financial management. The primary or the main objective is wealth maximization. But wealth maximization cannot be achieved by itself unless it is assured with profit maximization. Profit maximization in the short run and increase in the value of shares in the long run constitutes wealth maximization. Any company can make profit in the short run, but if they consistently make profit over a period of time, then the value of the shares of that company increases. So together, profit maximization and increase in value of shares leads to wealth maximization of the company. So if the question is asked, what is the objective of financial management? Then your answer will be wealth maximization. Suppose the question says, what are the objectives? Then we will say profit maximization and increase in the value of shares, that which will lead to wealth maximization. Now we have come to the end of this video. So let us do the case study. First, we'll understand what the case study is all about. In my previous video, I've already explained how to go through the case study. We will first study the question, and then from that viewpoint, we will look up the answer. So here the question says, identify the management that is concerned with optimum procurement as well as usage of finance. So this line we have already come across earlier, and give the main objective of management. Main objective, just one objective they're asking. So let's study. The directors of S Limited are interested in optimum procurement as well as usage of finance. For optimal procurement, they ask the finance manager to identify different sources of finance and compare them in terms of the cost and associated risk. So have you understood? Could you find out the lines that we're talking about? Yes. So here the key words are optimum procurement as well as usage of finance. Remember, I told you the 3 cases right in the beginning, in which I told you that if he has idle funds, he should use them properly, otherwise he'll unnecessarily pay interest. And optimum procurement, in case he has shortage of funds, then he should be able to know where he should get it from. Right? So let's look at the solution. So the answer is financial management, and the main objective of financial management is wealth maximization. That's all in this video, children. Thank you.